let's continue on with the next chapter, the next part of the next chapter. I put down here a statement of owner's equity, which we've looked at before. In this example, it's a brand new company. There was no capital balance, but then the owners contributed $20,000 to the business. There was net income of $10,000. There was withdrawal of $2,000. So now the ending capital is $28,000. But if you look on the trial balance, and this is just a partial trial balance. I didn't have room to put the whole trial balance, but you'd have your cash and all your other assets and your liabilities, and I just put ... because that would all be in there. But what we're concerned about are these accounts right here. The capital account has a balance of 20. See, this is the 20,000 that they contributed. But look, the real ending balance in capital is 28. It's not 20, it's 28. And when we prepare our balance sheet, we're going to put that 28. If you remember before, when we looked at preparing financial statements in that video, the ending balance is actually 28,000. So we need to get this to be 28, and that's what we're going to do in this video. Some other accounts we need to know: the withdrawal was 2,000, which is right there, the 2,000. The net income is our revenue. Now I have two revenue accounts. I changed this a little bit. Two revenues: there's sales and interest revenue, a total of 50,000, and two expense accounts: wage and rent expense. Now these withdrawal, sales, the revenues and expense accounts are temporary accounts, which need to be closed out. Okay, they're temporary. They don't continue on to the next year. I mean, the account's still there, but we have to zero it out because we need to calculate the withdrawals for the next year. We need to calculate and keep track of the revenue and expenses for the next year. Okay, well, closing out these accounts is a very easy process. When we close them out, what's going to happen is we're going to close them out to the capital account so that our capital account doesn't have 20,000, it will have actually 28,000. So there's a four-step process. The first step is to close out revenue accounts. So I'm going to abbreviate there. Close out our revenue accounts. Well, our revenue accounts have credits, right? They have credit balances, so we have to debit them. So we're going to debit, sales and rent. Oops, it's not rent, it's interest revenue. Sorry. We're going to debit sales and interest revenue. Sales is 40,000. Interest is 10,000. And then we're going to close it out to a brand new account called income summary. It's a brand new account. We're also going to close this one out eventually, but we're just going to temporarily put it into income summary. Okay? So by debiting these, that zeroes these out because these are credits. We're debiting it, so now sales and interest revenue are now zero. Okay? The second step is to close out our expense accounts. Well, we have two expense accounts. So to close those out, we're going to close them out to income summary. I'm going to abbreviate income summary, okay? And then we're going to credit wage expense and rent expense, okay? Wage expense was 30,000. Rent expense was 10,000. So the two of those together equal the closeout of 40,000 to the income summary, okay? So now we've closed out all of our revenues. Our revenues are now zero because they had credit balances. We debited them, they're zero. Our expenses had debit balances. We credited them, they're now zero. They're closed out, they're all ready for next year to accumulate the new transactions for the next year, okay? Now the third step is, well, we just created this income summary account. Well, now we got to close out that income summary. Close out income summary. Okay, well, income summary has a 50,000 credit balance and a 40,000 debit balance. So overall, it's got a 10,000 credit balance. So we have to debit income summary 10,000, and we're going to close it out to the capital account, to our capital account. Okay, now notice, this is what we're doing right here. We're giving the 10,000 to the owners, to the capital account. We're adding in that 10,000. That is this 10,000 right here. It's our revenue minus our expenses. This 10,000 income summary, when we close out that income summary, it goes into the capital account. So now we put the net income into the capital account because we closed it out to capital, and we increased capital by crediting it. And now the last step is to close out the withdrawal. I'm running out of room. I'll just say close withdrawal. And the withdrawal account has $2,000 debit balance, so we're going to close it directly to the capital account. So we're going to debit capital and credit, I'm going to abbreviate here, withdrawal account, and it's $2,000. Okay? So there's our four-step process. Now let's take a quick look at a T account here. Our capital account had a balance of $20,000. So there's the $20,000 in the capital account. We closed out our revenues to income summary. We closed out our expenses to income summary. So here are our two income summaries, credit, debit. So now we close out our income summary to the capital account. So look, we're putting it into, there's our net income going into the capital account. All right, and now the fourth step is to close out the withdrawal account. We debited the withdrawal account, $2,000. So now what is our ending balance? Well, we have 20, 30, another 10 is 30, minus the 2. Our capital account now has a balance of $28,000, just like our statement of owner's equity, which calculates our capital balance, says. So we've now closed out our revenues, we closed out our expenses, we closed them both out to the income summary, we then closed out the income summary to the capital account, that's where the net income, that's where this number just went, okay? And then we closed out the fourth step, our withdrawal. The capital, that $20,000 was already in there, all right? So then we get our ending balance of $28,000, which once again matches up with that $28,000, okay? Makes perfect sense, but once again, you've got to make sure that you understand how this works. You've got to spend the time, really think about it and understand. You may need to go back to previous videos to brush up on some of these concepts. But it all works out, as always, in accounting. All right, so good luck.